grow without being tied to eBay's structure. These can be gems.
Interesting. What about digging through filings like 13F?
Yeah, regulatory filings.
Yeah.
In the U.S., big investors, those managing over $100 million, have to file 13Fs quarterly, showing their U.S. stock holdings.
Where do you find those?
SEC.gov. They're public, due 45 days after quarter end. Useful for seeing what smart money is buying or holding. But remember, they only show long positions, not shorts, and they're backward-looking. And crucially—
You need to know which managers are actually good, not just famous.
Exactly. Fame doesn't equal skill. Do your homework on whose track record is worth following. Some stars are quiet, some famous names consistently lag.
Good point. What about company size? The small cap advantage.
Smaller companies often get less attention, less analyst coverage, and fly under the radar.
Meaning they could be mispriced more often, offer deeper discounts.
Potentially, yes. Buffett found lots of his early big wins in small Omaha companies before Berkshire got huge. But there's a flip side. Some investors, like Ralph Shive, prefer larger companies, arguing they have less downside risk if you're wrong, maybe more diversification within the business itself.
So it's a trade-off. Potential bigger upside in small caps, maybe more perceived safety in large caps?
It is. Depends on your style and risk tolerance.
Okay, beyond the financials and filings, finding ideas in everyday life, serendipity.
Absolutely. Keep your eyes open. Observing consumer businesses, retail especially. You might spot trends or problems before the market does.
Like that Tesco example. Seeing empty stores despite nice products.
Exactly. That was a real-world observation, boots on the ground, signaling trouble ahead. Your own job or background can also give you unique insights into industries others don't see or understand. Leverage what you know.
You also mentioned service companies, like recruitment firms, being good, deep value candidates.
Often, yes, because they're flexible. In tough times, their main assets are people and connections, not factories. They can cut costs quickly, making them quite resilient compared to asset-heavy businesses.
Makes sense. And these principles apply beyond stocks, like in real estate.
Definitely. Finding undervalued property involves looking for distressed sellers, people who have to sell. Understanding market shifts, interest rates, doing rigorous analysis, underwriting, stripping out the emotion.
And local contacts are key there.
Hugely valuable. Property managers, lawyers, CPAs, they might know about off-market deals you'd never see otherwise. Gives you an edge. And right now, assuming existing loans, especially certain types of agency loans, is seen as potentially a very good idea, though complex. Often needs a group of investors.
So value principles are transferable. Okay, with thousands of stocks out there, how do you filter them? Stock screeners seem essential.
Indispensable tools, really. They let you filter the whole market based on criteria you set. Low PE, high ROA, sales growth, whatever.
Narrows the field drastically.
Right. Maybe you screen for ROA over 10%, get 28